Enron was named America's most innovative company 6 years in a row. It was all fake. $74 billion, 25,000 jobs. One accounting trick. To understand how Enron fooled everyone, you first need to understand how real it seemed. Enron was founded in 1985 by Kenneth after merging two natural gas companies in Houston, Texas. In its early years, the company did real work. It owned pipelines. It moved actual natural gas. It was boring, profitable, and legitimate. Then Jeffrey Skilling arrived. Skilling was a Harvard Business School graduate and former McKinsey consultant who had a vision: transform Enron from a pipeline company into a trading company. Instead of owning physical assets, Enron would buy and sell energy contracts, betting on future prices the way a bank trades financial instruments. The idea worked. Enron's revenues exploded. The stock price climbed. Wall Street fell in love. By 2000, Enron had revenues of $111 billion. Its stock traded above $90 per share. Fortune magazine named it America's most innovative company for the sixth consecutive year. 20,000 employees, offices in 40 countries, a market cap of $68 billion, and almost none of it was real. Enron used two main techniques to hide its true financial condition. Both were legal, on paper. Both were designed to deceive. Technique 1. Mark-to-market accounting. This is where the fraud begins. Mark-to-market accounting allows a company to record the estimated future profits of a contract the moment it is signed, before any money actually changes hands. In theory, this is a legitimate accounting method used by banks and trading firms. In practice, Enron used it to book enormous paper profits from deals that might not generate cash for years or ever. Here is the specific problem. Who decides what the future profits will be worth? Enron did, internally, without meaningful external verification. Sign a 20-year energy contract. Estimate it will generate $500 million in profit over its lifetime. Book all $500 million as revenue today. Whether that profit ever materializes becomes someone else's problem. So who was checking these numbers? That brings us to Technique 2. Technique 2, Special Purpose Entities. Enron's CFO, Andrew Fastow, created hundreds of shell companies called Special Purpose Entities, or SPEs. On paper, these were independent companies with outside investors. In practice, many of them were controlled by Fastow himself, funded primarily by Enron stock, and used for one purpose: to absorb Enron's losses. When an Enron deal went bad, the losses were transferred to an SPE. The SPE's debt did not appear on Enron's balance sheet. Investors, regulators, and even most employees had no idea these liabilities existed. Fastow personally made at least $30 million running these entities. His own company's fraudulent vehicles were making him rich while destroying his employer. And the auditors? Arthur Andersen, then one of the 5 largest accounting firms in the world, signed off on Enron's books every year. They earned $52 million from Enron in 2000 alone, split between audit fees and consulting fees. The firm that was supposed to independently verify Enron's finances was financially dependent on Enron's continued business. When internal concerns about Enron's accounting arose within Andersen, the Houston office apparently overruled them. No objection was ever raised publicly. For years, a handful of analysts and journalists had questioned Enron's numbers. The company was generating enormous revenue, but its cash flow was thin. The financial statements were almost incomprehensible. Enron's response was dismissal. Skilling once called an analyst an expletive on a live earnings call for asking a routine question about the balance sheet. Then, in August 2001, Sharon Watkins, a vice president inside Enron, wrote a memo to CEO Kenneth. The opening line: the company could, quote, implode in a wave of accounting scandals. Lay received the memo. Nothing changed. October 2001. Enron announces a loss of $618 million for the third quarter. Simultaneously, it discloses a $1.2 billion reduction in shareholder equity related to Fastow's partnerships. The SEC opens a formal investigation. The stock begins to collapse, from $90 per share to under $1. In 14 months, November 8, 2001. Enron is forced to restate 5 years of financial statements. $586 million in previously reported profits simply did not exist. November 28th. Dinegy, a rival that had agreed to acquire Enron for $9 billion, walks away. December 2nd, 2001. Enron files for bankruptcy. At the time, the largest bankruptcy filing in American history. 25,000 employees lost their jobs. $2 billion in pension savings, gone. 59,000 shareholders lost virtually everything. Arthur Andersen was convicted of obstruction of justice for shredding Enron documents. One of the 5 largest accounting firms in the world, 85,000 employees globally, effectively ceased to exist within a year. Kenneth died of a heart attack before his sentencing. Jeffrey Skilling served 12 years in federal prison. Andrew Fastow served 6 years. Enron is studied in business schools around the world, but most of what gets taught focuses on the executives who committed fraud. The more useful questions are about the people who should have stopped it and didn't, because those failure modes repeat in smaller forms in ordinary financial decisions every day. Lesson 1. Complexity is a warning sign, not a feature. Enron's financial statements were deliberately complex. Analysts who questioned them were mocked or ignored. Investors who couldn't understand them assumed the experts had. In your own financial life, if you cannot understand how an investment makes money, that is not a gap in your knowledge to overcome. That is a signal. The deals that are hardest to explain are usually the ones where the explanation would cost someone money. Lesson 2. Conflicts of interest corrupt institutions, not just individuals. Arthur Andersen was supposed to independently audit Enron. Instead, they were financially dependent on Enron's fees. Their judgment was compromised before anyone walked into a meeting. When evaluating any advisor, financial, legal, or otherwise, always ask, who are they actually working for? What happens to them if they tell you the truth you don't want to hear? Lesson 3. When someone dismisses a reasonable question with contempt, that is the answer. Skilling's expletive response to a routine balance sheet question was a data point, not an outburst. Companies with nothing to hide answer questions. Companies with something to hide attack the questioner. This applies everywhere, to companies you invest in, to advisors you hire, and to anyone managing money that belongs to you. The response to scrutiny tells you more than the scrutiny itself. Lesson 4. Accounting can lie. Cash flow cannot. Enron reported profits for years, but its operating cash flow, the actual cash generated by running its business, was thin or negative for most of that period. The gap between reported earnings and actual cash was the fraud, hiding in plain sight. When evaluating any company's financial health, always look at cash flow from operations, not just earnings per share. Earnings can be engineered. Cash is harder to fake. The Enron collapse did produce one lasting result. The Sarbanes-Oxley Act out of 2002 imposed the most significant overhaul of U.S. corporate financial reporting since the 1930s. CEOs and CFOs must now personally certify the accuracy of their company's financial statements. Penalties for destroying financial records became federal crimes. Whether it is enough is a different question. Financial fraud did not end with Enron, but the specific tricks Enron used are significantly harder to execute today. The most important thing Enron teaches is not that executives can be corrupt. History is full of that. The most important thing is that complexity, deference, and conflict of interest can make an entire system. Regulators, auditors, analysts, investors, journalists look at a fraud for years and see success. Knowing how to cut through that is one of the most valuable financial skills you can develop. Subscribe to Founders and Fortunes. Every week we break down the biggest financial stories in history and find the lessons that actually protect you. Next week, how Toys R Us went bankrupt despite being the #1 toy retailer on Earth, and the financial decision that made it inevitable. I'll see you there.